2 years, not 2 months. The visible progress you're hoping for usually comes slower than you'd like. Even with consistent effort, it can take a long time before progress feels significant. It might be a year of writing and editing before your book really starts to come together. You may need 2 years of recovery from a major injury before you notice just how far you've come. It may take 2 years of yoga before you realize how flexible you've become. Take a deep breath, stop worrying about immediate results, and settle into a nice routine. So that kind of fits right in with what we're going to talk a little bit about today. We're going to talk, as we always do with Adam Lee and Jake Weatherford, we're going to talk through some financial planning, some investment management topics. Really today is more focused on investment management and portfolio management, if you will. So we're going to dive right in, but I just liked that quote of, hey, sometimes let's focus less on the immediate results. Let's focus on the long term. And when we're diving into things like world market capitalization, portfolio creation, that's, as we like to say, that's kind of our superpower, is our long time horizon.
Absolutely.
So today we're going to really get into world market cap, world market capitalization. What does that mean? We'll dive into that, and we'll dive into kind of what that looks like and how it represents itself around the world. So, Adam, why don't you just start with basically what does world market cap mean, and why is that a good thing to know? Why is that a good place to start with your investment philosophy?
Absolutely. So market cap, everybody knows what world means, right? It's all the countries in the world. Market cap is just a fancy word for how big something is. So, the market cap of Apple is a lot bigger than the market cap of, OG&E, the local utility company that's also publicly traded. So market cap is just shorthand for what is the total value of the company. And so we talk about world market cap, we're talking about the total value of all the different companies in the world. And, in theory, there's different types of companies even than we're talking about. There's publicly traded companies, which is, the primary driver of the portfolios we recommend to clients. But there's also private companies out there, right? There's insurance companies that are private, banks that are private. In some foreign countries, there's state-owned companies as well. Like Saudi Arabia owns their state oil company, Russia owns their state oil company, things like that. And so there's sort of this full universe of all the companies in the world. But typically, when we're talking about global market cap, we're talking about the public companies or the companies that someone like you or me could actually go invest in.
Mm-hmm. So world market capitalization, that is obviously separate from the economy, right? So I think that's one thing that we'll say, or just maybe in general can be misinterpreted, is like, well, I keep hearing about how big China's economy is. Well, their stock market is not really comparable to something like the United States. So dive into that just a little bit further about what's the difference between world market capitalization and the economy of a country?
Yeah, that's a good question. Some of it comes down to sort of what I mentioned. That's probably the most explicit way, is like, not all economies have a primarily capital driven economy with individual ownership. Like a lot of the entities in China are like state-owned entities, like state-owned banks and things like that. Russia owns their own oil production. Same with Saudi Arabia has some public shares in their oil production, but most of it's state-owned. So that's part of it, right? Is even if the economy moved one for one with the market, which it doesn't, and I'll get into, even if that was the case, in a lot of foreign countries, there's a lot of government ownership of firms that takes that out of what's available. And China's a good example of that. But even that, if you think of kind of the economy and economic growth as like a river, you could think of the stocks as like a boat in that river. And like generally it's going to follow the tide, right? And it's going to take a lot of effort to move against the tide. But at any given point, the boat is not going to always be moving equally as fast as the tide, but in general, it's probably going to end up in the general direction. And so, if economic growth went to zero for the next 100 years, like, would that say something about how stocks will perform? Of course, yeah. Like, it'd be difficult for stocks to continue to grow if economic growth, plummeted and stayed low for an extremely long period of time. But stocks are sort of it's all different types of things happening in stocks that causes their value to go up and down against the backdrop of economic growth, which has been really persistent for a really long time, sometimes higher in some countries, sometimes lower. Sometimes we have recessions in the U.S. But I mean, if you just think about the economy, the primary mode of the economy is growth. And you can think of it in terms of like, my car has a backup camera, and it's not like the fanciest car in the world, but getting a car with a backup camera 30 years ago, I don't know if you even could. Sure. And so there's little things like that we take for granted, but there's constant growth. So much so that it is seen as like a 5-alarm emergency when we have a couple quarters where there isn't growth.
Sure.
And we call it a recession. They're pretty rare, and they're usually relatively short-lived.
That's good. That's a good way to frame it. Last thing I'll say on world market cap, and kind of going back to the China example, I often get a pretty shocked look from clients or friends when I tell them the data I think I looked at was in 2021. You may have more up to date. But in 2021, the market cap of the United States was about 60% of the globe, and China was 4. People aren't so shocked that the U.S. was 60 in 21, but everyone seems to be shocked about the 4, and it is a very good point that a lot of that is state-owned. So.
Yeah, absolutely. And just think about, like, where would you rather start a business? Of, like, you know, where do you feel more comfortable that you're going to be able to have legal certainty in the business and, like, you know the rules and all that kind of stuff. It's pretty hard for foreign companies to start businesses in China. And so when you think about what's the value of a share of China's economy, well, to some extent, it's like whatever the government there says it is. And so you're not going to be willing to pay as much for those type of companies. To get back to your earlier point, though, one last point I want to put on it, though, is the part of the reason world market cap is important is because when we're thinking about how we're going to invest money, our starting point should be everything. And obviously, we don't just necessarily go out and invest pro rata in every single company in the world, but that is our starting point. And then we have to prove to ourselves, okay, why should we exclude certain securities from the portfolio? Why should we overweight certain ones over the others? But our starting point isn't, hey, we're going to start with a bunch of cash and then individually pick the companies we like. We're going to start with everything in the world, and then we're going to start to exclude things or under or overweight them based on how much we like them relative to other things in the world.
And if you do exclude something, you have to have a good reason why.
Absolutely.
So to start with anything less than that is a poor decision because you've already made a decision by doing that. So to start, and we're going to get into emerging markets, international, we're going to start there because we're going to put U.S. last. Because typically what a lot of individual investors do that may be watching these videos is they start with not just the U.S., but not just the U.S. stock market, but 500 of those companies or less than that. And there needs to be a really very good reason to do that if that's going to be your decision. And so we're going to get into that more. We'll dive into emerging and international next, and then the third part of our series will be U.S. Anything else to say on world market cap before we move on?
I think that's great.
All right, thanks a lot. If you want to dive in further to emerging markets and international, you'll be able to watch our video. It should be coming out here in about a month, and then U.S. will come out about a month after that. So thanks for watching. Hope is like a road around the country. There was never a road, but when many people walk on it, the road comes into existence. We're going to start every one of these with a quote because that just seems like a good way to jump in, right? So, okay, we've gone over world market capitalization. Now we're going to dive into a few different markets. This video, we're going to dive straight into emerging markets and international. What is emerging? What is international? Why are they separate from one another? Why does emerging get its own little category? And how are they different from the U.S.? You'll have to wait for the third video to dive into the U.S. because that's probably the one everyone wants, right? So let's start there. Adam, emerging markets, international. Why? Why split them up? What's the difference? And then we'll get to why it's important to have it in our portfolio.
Yeah, absolutely. So I'll answer your question very generally, and then I'll actually answer a question you didn't ask, and then I'll get to the question you did ask. Generally, it's useful to split them up just because there is a difference between the United States and, the Congo or Estonia, right? Like there's different levels of development in different countries. And it's helpful for investors to be able to have buckets of, hey, these are really highly developed economies. These are kind of the next most highly developed economies. The line is a little arbitrary and like reasonable people can disagree. Like as an example, depending on who you ask, South Korea might be a international developed economy or it might be an emerging market economy. So it kind of depends there. But to answer the question you didn't ask, one misconception I think happens a lot is assuming emerging markets are like the least developed countries in the world. And the answer to that is most countries in the world are not even necessarily in an index. So like if you don't have a regulated capital market or appreciably sized stock market, you're not even going to be in an index. The next level up from that is something called frontier markets. So this is what I think a lot of people think of in their head when they're thinking about emerging markets. So frontier markets are, the handful of countries that maybe have some capital markets, but they're not as fully formed. Like Pakistan would be an example of a frontier market. Emerging is the next step up after that. So it kind of passes the threshold for they've got a capital market, they've got a stock market. It's reasonably stable in terms of expectations, in terms of rule of law and things like that. But it's maybe still a little, young, or there's still some maturation in terms of all the regulations around it. And so examples, South Korea is in some cases an emerging market. Poland's an emerging market. Israel in some situations has been classified as an emerging market. So those are some examples of Greece is an emerging market. Examples of countries that are emerging markets.
So you've got to have a market, obviously. Yep. You do have to have some stable government regulation. Any other things that come to mind that are requirements to actually be considered as an emerging market?
No, and like I said, I mean, it's a little bit like reasonable people can disagree type thing. So like South Korea is the example of that has been in and out of certain different classifications of emerging markets. It really depends. I guess what I would say is track record's a big one. It takes some time, stability over time to go from kind of emerging to international developed. But fundamentally, one example I bring up is, Taiwan is often lumped into emerging markets, and they have one of the most sophisticated chip manufacturing companies in the world. Taiwan Semiconductor produces, probably more chips than any other company in the world in terms of units and in terms of value. Maybe it's up there with NVIDIA, but it's an incredibly important, sophisticated company. And so I say that to say, for people thinking about emerging markets, they shouldn't think of it as like, oh, this is just like the local utility at a less developed country. Like there's all types of companies and all types of market segments.
That's good. Yep. That's a good distinction. So that's a good segue into international developed. And just a quick fact, again, as we said, the U.S. represents around 61% of world market capitalization. That means that international and emerging represent the other 40. So talk to us about, okay, we've kind of defined emerging. Now let's go in more to international developed countries, maybe some examples, and how they got from emerging to international, or why they're considered international instead of emerging.
Yeah, absolutely. So these are going to be like the UK is an example of one, France, Japan. Typically these markets have been established and mature for decades. So South Korea is a good example of thinking, South Korea actually in like the 1950s, I think had lower GDP per capita. That's a nerdy way to say it, but then North Korea, which is like a crazy thing to think about in your head, right? And so that's 70 years ago. And then at some point they crossed into like, they have capital markets. And now like you go to South Korea, you go to Seoul. I've never been to Seoul, but the capital of South Korea is like, it looks like Times Square. And there's plenty of very wealthy people in South Korea with like, high standard of living jobs. They've got pretty high GDP per capita. And so that's an example of one where, it's probably been that way in South Korea for a couple decades, I would say. They've been kind of like in parity with, like a UK or France or US in terms of kind of the legal structure and the market structure. And so, if you just started from scratch today, I think clearly South Korea would be a developed international, but it just takes some time demonstrating that you've got, big companies in a well-regulated capital market to be able to kind of move into that group.
Yeah, that's good. It's always kind of shocked me that the UK represents like 4 to 6% of world market capitalization. I don't know why, but that's always come as a shock. That's good. And let's talk a little bit about before we wrap this video up. Let's talk a little bit about, why do you want to own companies outside of the United States? Why do we want international and emerging exposure?
Yeah, that's a good question. So I go back to a video we previously posted, I think last month, about the starting place when you're thinking about investment allocations is you start with everything and then you build a case against some things and for other things. And so the starting point should be everything. And so that's the first reason why. And the reason we don't then kick all of those companies out, we do underweight emerging markets to some extent because of the newness of the markets. So we underweight those a little bit typically in client portfolios. But there's certain types of companies that are, and this gets a little bit into our U.S. Discussion, certain types of companies that are predominantly headquartered in the U.S., like major tech companies. We have an outsized share of the world's major tech companies in the U.S. If you look at international markets, you're going to have higher concentrations in energy, in mining, in utilities. And so by making a bet, that excludes international companies, you're kind of making a backdoor bet against certain types of industries, because there are certain types of industries that have to be closer to the population. Like a utility has to be closer to the population. A mining company typically is closer to the mining resources. The other point I would make, though, is it's not as clear cut as people think in their heads. My favorite example is, Apple is an example, U.S. headquartered company. Over 50% of its sales occur outside the U.S. Novo Nordisk is a pharmaceutical company headquartered, I believe, in Denmark, and so it would be considered an international developed company. It sells over 50% of its products to the U.S.
Exactly.
And so it's not necessarily true that international companies are reliant or primarily reliant on international markets in the same way that it's not necessarily true that U.S. companies are primarily reliant on U.S. markets.
Right.
So we really want to start with everything, and the international to U.S. distinction just isn't as important and isn't as definitive as I think people think of in their minds.
It's a hard line to draw because that's a great example that you gave. And also, it's just, what if the next big thing is invented in the UK, right? Why, without good reason, would you exclude that from your portfolio? And again, as we always say, this isn't portfolio advice. Overweighting, underweighting, that's everyone's own decision. We're not here to tell you what to underweight and overweight. What we're here to do is to say, hey, it might be a good idea to start with everything and then make decisions on what you want to exclude instead of just doing that by choice of, I guess, the fund provider or the fund that you choose, right? So start with everything and then make your own decisions away from certain things. Absolutely. So instead of letting that decision be made for you, I guess. So that's good. Anything else you want to add in on international before we wrap this one up?
No, I don't think so. I think that covers it. It's an important, it's like you said, emerging markets is maybe a third of that 40%, and then international developed is 2/3 of that 40%. So it's a really sizable chunk of the value of all the companies out there in the U.S. And it's great international companies out there: Toyota, Spotify, Novo Nordisk. Tons of names out there that are household names that you'd recognize that you probably want to consider having in your portfolio.
Don't take my Spotify away. Don't take my Spotify account away from me. All right, well, that's great. Thanks for tuning in. Next month will be on the U.S. And I guess that's that. Thanks, everyone. If I'm worth anything later, I'm worth something now. For wheat is wheat, even if people think it is grass in the beginning. Little Vincent van Gogh to start this one off, Adam. Nice. Okay, we've dove into world market capitalization. We've dove into emerging markets, international markets. Now we're bringing it all the way back to the good old United States of America. Let's talk about what is the United States of America stock market. Yeah. Not from where is it, or people know that. But is it 500 companies? Is it something different than that? What is the U.S. stock market? How do you gain exposure to it easily? And anything else we want to dive into. But just and the third thing is how does that relate to the world market cap, right? Why is it important to own the U.S. just like it's important to own international emerging? So take that where you want to, and we'll get into it.
Yeah, absolutely. So the U.S. stock market's the biggest, most liquid, and liquid means basically there's people transacting in it all the time, every day, tons of buyers and sellers. Biggest, most liquid, most successful, longest track record stock market in the entire world. It makes up more than half of the value of all the stocks in the world. It is very large relative to the size of our GDP, which is what the country produces. So we have an outsized stock market relative to our GDP, which is also very big. We're one of the wealthiest nations in the world as well, just in general. So it is a huge, really important stock market. The companies in that market don't just sell in the U.S. They sell overseas. Apple sells tons of stuff overseas. The U.S. automakers sell overseas. All kinds of Boeing sells jets overseas. All kinds of U.S.-based companies are serving an international market. So it is the most important stock market in the world.
Mm-hmm. By virtue, if nothing else, because it's the biggest. Absolutely. By far and away.
Yes. Yeah.
So, we made this point in the last video, but I want to address it again. If I've heard of some people buy, hey, I'm going to buy the S&P 500 because I know they sell widgets in the UK also. Well, that's true, but we got to remember that there are companies elsewhere that sell widgets in the United States. 100%. That's why we like to start with the world market cap and think that could be a good idea for other people. So coming back to the United States, okay, so now I believe, okay, let's start with the world market cap. I'm going to buy the U.S. There's a lot of different ways to do that. Yep. When a viewer logs on to whatever they log on to, Fidelity, Schwab, E-Trade, Robo Advisor, XYZ, I see all these U.S. funds. How do I even know where to start?
Yeah, it's a good question. So similar to what we talked about in the global, market cap, international, and emerging market, you want to start with everything. Yeah. Is the starting point always? You don't want to start with nothing and build up. You want to start with everything and start to subtract or tilt away. There's about 4,000 publicly traded companies in the U.S. The S&P 500 is something that people might be familiar with. It's a really popular stock market index that takes the 500 most valuable companies in the U.S. Those companies right now represent a little over 3/4 of the value of all the companies in the U.S. So the big ones tend to represent the most value.
Sure.
So if you just do the math here, so I'm saying the U.S. is 60% of the world, and then the S&P 500 is 3/4 of that, and so the S&P 500 is close to half of the value of stocks in the entire world. But getting back to your other point, the S&P 500 is a very special group of stocks in that it's very large companies based in the U.S. It tends to lean towards tech-focused companies, and so by making a bet, just on the S&P 500 or just on some small portion of the U.S. market, it's I guess it would be better than if someone came to me and said, sure, okay, I'm owning the 50 biggest companies in France. I'd say, well, 500 biggest in the U.S. is probably a better, more total market experience than the 50 biggest ones in France. But there's really no reason to stop at 500. And the reason that the S&P 500 exists is because before that, the most popular index was the Dow. And the Dow was invented in, like 1900, and they were doing their best. They had horses and stuff. They were just getting cars. And they were like, well, maybe we'll keep track of 30 stocks. So then instead of following individual stocks, we can put out this list of 30 and that'd be a little, and it was better than nothing. And the S&P 500 improved upon that. But now we've got computers,
right? And
there's really no reason not to keep track of everything.
Well, very good point. Just accessibility.
Yep.
And we're making the assumption here that everyone's buying funds.
Yep.
And so the S&P 500, the Dow, is a good way to gain exposure if your other option is to buy the individual stocks yourself.
Absolutely. Yep.
And that's not been around that long, yep, right? So that long, right? I mean, it's been around most of our lifetimes, but in the grand scheme of things, it's not been around that long. So these funds are a good way to gain exposure, but it's like, okay, do you want 30? You want 30 companies? Well, I guess that's better than one. Do you want 500 companies? Okay, I guess it's better than 30. Do you want 14,000 companies that represent their whole market cap? Well, it might be a good place to start type thing. So it's a good distinction you made about the Dow versus the S&P. What else should people know about the U.S. stock market from a standpoint of how it represents itself within the world market cap?
Yeah, they should know that it is, the U.S. economy has been really successful at creating these large international companies. And so we are, in the U.S., relative to the whole world, to the value of all the companies out in the world, we are overweight tech significantly relative to the rest of the world. And that's, when you think about it, it kind of makes sense. Amazon, Facebook, or now called Meta, you've got Tesla up there. You've got all kinds of high technology companies that have been, born out of the U.S. economy. And we have less, in Europe there's Airbus and there's Spotify, but that's not the same caliber as, Apple, sure, Amazon, and things like that. And so that's a big concentration in the U.S. So when technology has done well lately, the U.S. has also done well. And it's important to think about, what are the bets you're making in your portfolio? Do you want to make a bet on technology?
Right.
Or if you allocate to an S&P 500 fund, are you kind of accidentally doing that relative to, internationally there's more mining, there's more energy companies. Right. Not more energy companies. Energy companies and mining are a larger percentage of the value of other companies. Utilities, banking actually is a little bit bigger internationally. I'd say not so much because international banks are bigger, but because they have less technology, right, that kind of crowds it out. Yep.
Well, and just kind of becoming a theme in this 3-part video series, if you want to make that bet, fine, but just do it consciously. Yep. Don't do it by accident. So, well, that's great. That's the U.S., that's emerging, that's international, and the world market capitalization. So hope you enjoyed these videos. We'll be putting out more and may put out an article similar to this. So thanks for watching. We'll see you soon.